Welcome into the reaction channel, folks. Got a fun one for you here today. This is a banger. So we got a three-piece Tom Lee to get into. Everybody's favorite bull right at the beginning of this video. So he went on CNBC 4 days ago, spoke about his views on the market. Then yesterday he talked about the S&P 500 going to 6,600 before year end. This is a massive call, and the reason being is right now S&P 500 is under 6,000. So this is a huge monumental call. Then just an hour ago, while I was working, all of a sudden I heard in the background, I had CNBC on. He went on and spoke about a melt-up rally that's coming into the market. So looking forward to reacting and sharing my opinions and perspectives on all those Tom Lee videos. And then I want to react to this one. This gentleman's talking about the markets have never had two 20% declines in 1 year. And this won't be the first time. So I think that's going to be an interesting one to kind of react to, share my opinions and perspectives on that. From there, we're going to get into this post I made here today on what are, like, if you had a beginner $10,000 portfolio, how would you diversify the funds around? Andre had posted it, and I'll kind of share my opinions and perspectives and one change I actually made to that essentially, and we'll get into all that. So, by the way, I appreciate everybody joining me as always. Action-packed times. Thanks so much for being here, folks. Thank you for doing the one thing and the one thing only I need from you, and it's hit that like button on this video. I hope you can do that for me. Even if you're not the type to hit the like for me. I appreciate you for doing that. If you want to subscribe to the channel, you can certainly subscribe. Also, big congratulations to the folks in my private stock group. This was before signing last week, and then after signing them up, 17 people, 17 members just hit six-figure club in my private stock group, and one person has now hit the seven-figure club. And we've now had, since I started my private stock group many years ago, we've now had about 200 people or so scale to seven figures plus in their portfolios. We've had a few actually scale to over $10 million in their portfolio, and we've had somewhere between, I would say, 500 and 800 people scale to more than six figures in their stock market portfolio. So in order to get that award, you just have to be a member of my private stock group and essentially show screenshots that your portfolio is obviously six figures, seven figures, and we send one of those awards. We got the seven-figure award and then the six-figure diamond award. We send those to your house complimentary. You also get your steel membership cards in the mail. If you're looking to apply to join my private stock group, private wealth group, that'll be pinned comment down there. Access to all my course curriculums, access to my private Discord chat, all that good stuff, okay? And exclusive weekly videos. Alrighty, guys, let's start getting rolling with this. Oh, by the way, one other thing I posted here that I think is important is look at this, folks. Look at this. You're going to be flipping my flapjacks. The Nasdaq and S&P 500 are now only 3% away from all-time highs. 3%, folks. What a change. And I said to the private stock group members, I said, unreal how fast market sentiment can change. Unbelievable, right? Like, go back a little over a month and a half ago, and it was just doomsday, you know, it was just the market's going to keep crashing forever. And now look at this, we're 3 percentage points away from all-time highs, right? And like I've been telling you guys from the beginning, this year reminds me so much of 2018. And in 2018, we hit new all-time highs around June, July. And then we busted through those. And then, so we'll see. If this is a 2018 type year, you will hit new all-time highs likely in the next few weeks. And then we'll bust through that and go to much higher highs than we've ever seen in regards to the market. And then we'll see what happens this fall. That could be drama times. Okay, let's go ahead and react to Tom Lee.
Need to buy the dip. Do you still feel that way when we get these sort of tariff back and forth headlines?
We still think dips are going to be pretty shallow. It's still the most hated V-shaped rally. I mean, the COVID rally was hated until we made new highs, and the rally from the fall of 2022 was hated until we made new highs. It's not any different this time. Hedge funds, I think, have really been very cautious. They were forced to sell near the lows, and we know there's $7 trillion cash. So while a lot of people are calling a top, I actually think that this is more of a, mid-cycle kind of start of a new bull market.
So why doesn't the market care about tariffs? You hear, oh, this happened. Listen, exactly what I told you guys was going to happen several months ago. Eventually, the market's going to stop caring about tariff drama and what Trump said and didn't say. There was an adjustment period. Trump gets in office. A lot of people hadn't been used to a president. Biden, you didn't hear from Biden for 4 years. You never heard from the man for 4 years. And then you get Trump in office, right? Takes over in January. Also says we're going to do this, that, tariffs, blah, 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 threats, all this stuff. And people freak out because they're not used to that. I'm used to it. I invested heavily during Trump presidency 1.0. And so I already knew coming in 2.0 exactly what this story was going to be. There's going to be a lot of drama, a lot of talk. And I explained this on Inauguration Day. I did a video on the main channel, got 173,000 views. On the Trump stock market, it's going to be a roller coaster. I laid out the whole next 4 years. You know, and so what happened is everybody freaked out earlier this year, right? Took an adjustment time period. And there's going to be other freakouts in the future. This isn't the only freakout that's going to happen. There's going to be other ones that come in the future, but for right now, people are they're bored of the same old story, tariff drama. The market's bored of that now. You can't get the market down on that. You need something new to happen. Big.
Why? Why do you feel that way? With the economic data starting to weaken and the fundamentals changing as a result of all the tariff drama?
Well, I mean,
Whoa, wait just a minute. In all due respect, ma'am, listen, hold your horses. Have we seen what just happened with all the big tech companies? All the Mag 7s? Other than Tesla, let's take Tesla out. They're a whole situation. Look at the other 6 of them. Numbers look great. Guidance is fine. Conference calls were good. What fundamentally changed with those companies? Not much. Even talk about the one-off charges they're going to have to take because of the tariffs and things like that. It was actually very minimal. Like now, NVIDIA hit a little bit harder because it was like an $8 billion potential impact because of obviously the Chinese restrictions and whatnot. But at the end of the day, like if NVIDIA still ended up, guess what? Beating their numbers and posting a good guidance number. So you could say maybe they were the most directly hit, but they still beat their numbers, right? They still had a really good guidance. They're still feeling great about this year, next year. So, you know, you just don't have a lot to go off of. If all those companies were all of a sudden, you know, revenues about to trend down big, things were about to get ugly, that's a whole different situation. Amazon sounds like it's about to go through a revenue acceleration, not deceleration, acceleration at Amazon.
Just did a relative comparison. When I look at the company outlooks now compared to February 2025, I actually think the outlook's actually better. You know, when we look at 2026, I think we have better visibility on deregulation and potential tax benefits. I think the tariff risk is actually diminished compared to February 2025. And while the Fed's been on hold this year, I think that there's a case to be made. They're going to be dovish next year given what's happening with housing. And I think the trend in core inflation, and that's more important to markets, is the Fed in 2026 than what the Fed does the next couple of quarters. So, I mean, overall, I think it means PEs could go up.
Tom, are you more confident in the Mag 7 idea or the small cap idea?
Carl, it's an overused word, but I think it is a bit of a barbell. I mean, in the near term, the washed out groups we thought would be the beneficiary, and the Mag 7 was really leading that because so many of the Mag 7 peaked earlier and bottomed before the S&P did. And we still want to stick with that. But as I look at the second half, I think the small caps really have a strong case to be made, because as long as we move towards a tariff resolution or the markets feel that way, then I think investors can actually start putting flows back into stocks other than the Mag 7.
Are you keeping a strategy in which
Rivian, I mean, one part of me says Rivian could be interesting from the perspective of, you know, obviously a lot of people are anti-Tesla, right? We know that. And so they refuse to buy a Tesla under any circumstance, essentially. And so if you want to get an EV, I mean, you know, do you want to buy from a traditional automaker that makes internal combustion engines? Probably not. So you want to buy from a company that actually like focuses on EVs, does EVs, and there's not many to pick from outside of Tesla. One of the only options you have is Rivian, right? You also have Lucid, but they're in such, you know, their financial situation is not ideal at Lucid, in my opinion, at all. So if you said I got to get an EV outside of Tesla, I'd probably go Rivian, right? So maybe they benefit overall. Now, he also likes SoFi, Crocs, Southwest. How do I feel about those? Southwest, you know, I don't love the airlines, but I don't think they're at bad valuations right now. So I guess it's okay as a trade, right? SoFi, listen, I love SoFi. I think SoFi has great long-term potential, right? I have, 5,000 shares or so in the public account. You know, if they execute over this next decade, they could become a financial giant. Crocs. You know, the thing that scares me about Crocs is I just wonder if it's a fad, a trend, right? And I'm just not confident that like the sales numbers Crocs are putting up right now, I'm not confident that they're still going to be doing those numbers in 3 years from now or 5 years from now. Maybe they are, right? Maybe just as many kids all want Crocs like they have wanted over the past year or two. Or maybe that changes. And 3 years from now, 5 years from now, like people aren't interested in Crocs, or maybe they just get commoditized massively. Like, I don't know. And so therefore I get kind of scared of Crocs, that it might just be like a trap stock where you think like, oh, this is a great company, like look at how much money they make, but then like revenues start to downtrend in a year or two from now, right? And then they can just never get back there. Doesn't mean the company goes out of business or something like that. It just means like you just have revenues downtrending. Then no one wants to own a stock where the revenues just downtrend for year after year after year for years to go in the future. So I do, that at least is a concern. That's what would keep me out of a stock like that, is a concern about that. Do I feel confident that that's going to happen to them? No, but I also don't feel confident that they're not a trend or a fad. And so that's kind of scary.
If tensions go back up in your back pocket somewhere, and how does that read?
Well, I mean, I think we're all operating with the realization that there isn't necessarily an end game in sight for the tariffs. And I think these court rulings may push us a little closer to the end game. That's why I think it's a slight net positive. But at the end of the day, we all have to realize it's still a process. But I think investors are too pessimistic about the outcomes. I mean, I think we've been a little too the market's been too pessimistic about what tariffs could do. I think we've had a lot of folks that turned structurally bearish because of Doge. But when we look at what's happened in the last couple of months, I think it's more bark than bite, I guess is the best way to put it.
Okay, but there's something that scares me here. Okay, and obviously we're about to get on Tom Lee's big call here, right? And then we'll get into the FOMO video from just an hour ago or so when Tom Lee went on CNBC and was asked a bunch of questions. But there's something that scares me here, right? He mentions there about the market's been far too pessimistic. 100% true. Especially in April. Like, oh my gosh, like the market was so pessimistic. It was ridiculous. You would have thought the whole tariff drama was like guaranteed to stay, and it was just like, the end of the world. Like literally the way the market was acting like it was the end of the world. Like the Nasdaq fell, lost around a quarter of its value like that. Like that. Like a quarter of its value. Not like it went down 3%, 5%, 7%. No, it lost a quarter of its value in a matter of weeks. Not in a matter of several months. Not in a matter of several years. We're talking in a matter of weeks. It lost 25% of its value. Far too pessimistic. 100%. But something scares me. And let me tell you this. We start talking about this market hits new all-time highs, and then we blow through all those all-time highs this summer, right? And a lot of excitement keeps kind of building into late summer. I do worry that the market can then get too optimistic, and we could be setting up for a dramatic major fall in the market in the fall time, similar to what happened in 2018. So that's just something that's a little concerning out there, which keep in mind, if that does happen, it'll be a great buy the dip opportunity if that happens this fall, which is certainly no guarantee, right? And if we do have just an overwhelming amount of optimism come in the market over the summer, we blow through all-time highs and just new all-time high after new all-time high, it could set up for a hedging opportunity come, we can call it August, September, maybe October, kind of getting ready for some fireworks there. Because, the market has this tendency nowadays to get far too pessimistic and far too optimistic. And it happens in a matter of, 6 to 12 months. It's not like you have to wait years and years for this like you used to back in the day. It's 6 to 12 months and, Okay, next one up here. Tom Lee talking about making 6,600 on the S&P seems more achievable today than it did in February.
CIO and head of research and a CNBC contributor. He's very calm, even in the face of adversity, but this time the markets have come back to you in a big way. Because at this point, I think they've exceeded your targets they were a couple of months away from where we are right now, and we're already there. So you're raising your targets overall?
Yes, I think, when at the April lows, we thought we could make a move back to 5,500.
Right, we're at 5,900 on the S&P.
That's right. But our full year target was 6,600. So I think that's still a reasonable expectation.
You never
by the-
changed that.
We haven't changed it.
Never did. Even on
No.
April, the week of April 2nd or 7th or 2nd, you didn't change it.
No, it felt very shaky because that would have been, a couple 1,000-point move needed. But now that I look at 2026, I think businesses are in better shape now than they were in February. So I think making 6,600 actually seems more achievable today than it did in February.
You think a bull market started April 7th, or a new bull market started
Yes.
April 7th? In everything, because the Nasdaq already, if you just use 20% to measure what is an actual bull market, people think we need a broader indicator, a broader reason to call something a bull. But at this point, I think the S&P is also in a bull market.
Yeah, I think that the waterfall decline into the April lows was such a reset of sentiment. People talked about Armageddon, and we saw some of the most rapid deleveraging of hedge funds ever, and a collapse in investor sentiment, and a huge change in positioning. So those are, I think, things that look like what happens in a bear market. And the ISM has never broken above 50 in a sustained way. Market tops usually need an ISM to stay above 50 for a period of time. So I think we're at the start of a bull market. And as I look at 2026, I think housing could actually be a big lever to pull next year.
What do you think of the recent inflation data? And is it real? Is it lasting? Is it going to turn around and head back up because of tariffs? Were you surprised at those numbers on the last couple of Friday and then a couple weeks before then?
Well, as you know, the inflation for the last month actually has defied expectations because a lot of people said these shortages would cause a spike, and instead core inflation actually has been trending lower. But to me, inflation was really a story about housing and auto insurance. Those were powering inflation for the last 2 years. I mean, combined, that's 75% of the rise in inflation. Housing is actually now subtracting from inflation month over month. And I think in some ways, on a real-time basis, that tells me I don't think core inflation is actually going to be turning up, even if goods prices go up.
You don't?
No, I kind of agree with Waller's comments.
You do agree with Waller's comments?
Yeah.
So you're anticipating cuts, several cuts this year?
Well, I think that if core inflation behaves, then we are in a really tight real rate environment, right? 4.5% monetary policy and 2.5% or 2% core inflation. I mean, there's a need to actually reduce interest rates.
So Tom Lee mentions about real estate there. Yeah, my personal opinion is, especially if people are looking to buy a new build house, I think you have a lot of leverage over this next few months to negotiate deals. Here's what I'm seeing in the real world. I'm seeing several builders want to super incentivize. I mean, super incentivize right now. And when I say super incentivize, I'm talking about the most incentives I've seen, and I constantly pay attention to all the biggest home builders, how much they're incentivizing in the real world. And I go to these places, talk with them, right? Talk with the salespeople and whatnot, right? This is they're given the most incentives I've seen since way before Rona. I'm talking like you've got to go back. I think you've got to go back like nearly a decade to see this level of incentives that I'm seeing out there in the marketplace at this point in time. Because even prior to Rona and the blow off top of housing and just, housing prices going crazy and whatnot, even back then, especially in like Vegas and Phoenix and whatnot, they weren't doing heavy incentives. It was if they were doing anything, it was like throw you the smallest bone in the world. Like, we'll give you like $5K at the design center, which is like nothing, right? Very small incentives. Then obviously during Rona, housing got so heated up that they stopped taking away any incentive. And they just kept going up on price, up on lot price, up on everything, right? And now I'm seeing, they're not going up on price anymore. On lots, I'm not seeing them go up on price of the actual homes. And they're starting to do a lot of incentives. And so I actually believe this bit of time we're in for this next little bit is actually a great time if you're looking to buy a new home to negotiate. Now, obviously, mortgage rates are not ideal right now, but if you can afford it, right, and it's not like you're busting your budget for it, it's okay, right? And then you can always refinance down the road. So that's something to kind of keep in mind there, right? So a lot of optionality. In terms of existing homes, You can get some deals out there, but a lot of buyers are still kind of in that 2021 mindset, 2022 mindset when real estate was kind of peaking there, where they think they can get this crazy dollar amount. So there's still a lot of existing homeowners that are just in this like delusional state of thinking their home is worth X amount of dollars when it's not really worth that much, right? And so the home builders, those people aren't emotional. They look at what's going on in the market in front of them right now, and they got to say, okay, we're going to do, we got to give them a deal on this, a deal on that, a deal on this, right? They'll let you get a lot of your way right now.
Do you, Tom, at this point think that interest rates, because it doesn't matter whether we reduce or not, would the long end go up if they reduce the short end because of 37 trillion or this bill that's the big, beautiful bill? Are there worrisome things on the horizon other than inflation, current inflation?
Well, yeah, the U.S. is on an unsustainable sort of path for deficits, but Japan's actually had higher rates, and their interest rates have been behaving for a long time. I mean, not recently. So I think the long end is essentially unpredictable. When investors worry about it rising too dramatically, then I think that's when the bond market can have some influence on both the Fed and the Treasury. But I think at these levels, it's not that alarming.
What's Bitcoin? What is it moving with? Just risk assets at this point? It got back to an all-time high, which you were forecasting as well. But now I think, what are we, 104 this morning? So it's pulled back.
Yeah, I think it's consolidating. It makes sense. Bitcoin is responding to global liquidity, which is moving up, and I think anticipating a dovish Fed next year. So that's a tailwind for Bitcoin. Yeah, but if you're having something forever, it'll always.
So what's your terminal value?
Oh, I like this. This is actually good.
Okay. Thank you. And we're talking years, obviously, but 95% mined. I don't think the last one is mined till 2150 or something.
Yeah.
It's getting harder and harder.
Yeah, I mean, depending on what decimal you want to use, it's probably like, 2040 or something. But but if you're having something forever, it'll always.
So what's your terminal value?
That's what we just said.
Yeah, I mean,
the final.
He said 2.5 million.
2.5 million at the end.
Yeah.
Or maybe, maybe higher.
Or maybe even higher.
I didn't appreciate that point.
Yeah, I mean, it could,
But I guess maybe the way I meant that is, does that happen at the end after it's all?
When it's all mined.
When it's all mined?
Yeah, and there'll be network fees generated.
Or does that happen before it's mined?
It's like as if Berkshire did a buyback and there was only one share left. What would Berkshire's share price be? It'd probably be the market value of Berkshire.
And as you said, if I go halfway to the wall, and then halfway to the wall, and then halfway to the wall, I'll never get to the wall.
Yeah.
I like that. That's a good old math for you. Yeah, you keep going halfway forever, you never get there, right? Okay, let's pull up Tom Lee's latest comments here.
For a melt-up rally, that is what our next guest is calling for in the months ahead. He is Tom Lee. He is FundStrat's co-founder and the head of research, also a CNBC contributor. And as you see, he's here at Post 9. Nice to have you.
Great to see you,
Just saw
Scott.
Dietrich on. He's bullish. And you are too, but you say too many people are not.
Yeah, I would. You'd think that with the S&P doing well this week and a great May, investors are bullish. They are not. In our calls and Zooms with portfolio.
Listen, I got to explain this, okay? Because Tom Lee was talking about hated markets, right? And 100%, it doesn't feel like we're in some super bullish time, even though you look at the market and it looks insanely bullish. And it's because still so many hedge funds, still so many investors are cautious, kind of not feeling great, right? Once again, that could change if this market hits new all-time highs and then starts busting through all-time high after all-time high. Things will change quickly. But remember this. Many of the most insane rallies you'll see in the stock market are hated rallies. Meaning, a lot of people were offsides, they were not nearly as invested as they wanted to be, and the market just rips. And people are mad. They're disappointed. They're sad because they're like, we got bad news, bad news, bad news, bad news. I'm not invested the way I want to be invested, and the market just keeps going higher. So it's a hated market. And then is exactly what we've had over this past month and a half to 2 months. No, for the people that were buying the dip heavy in March, and especially in those first few weeks of April, right? You're happy as can be, right? People like myself, people like a lot of you guys watching this, we're like, this is awesome, man. But we're a very small minority. You got to understand, so many of these hedge fund managers were selling. While we were buying, they were selling. And now many of these stocks are up 30%, 40%, 50%, 60%, 70, 80, 90. Some have even over doubled from the April lows. And so people are looking and they're like, are you kidding me? Like, there's still so much bad news. There's still so much drama, tariffs. We don't have, conclusive evidence of which way things are going, blah, blah, blah. And so it leads to people hating a bull market like this, right? But you got to understand, when things look great again, there's not going to be as much money to be made. That's the thing you got to understand about the stock market. When everything looks great, you can make money, but that's not when the most money's made. The most money's made buying when things look bad, scary. I don't want to own it. That's when you make the real big bucks. A situation like what has happened the past few months, or a situation like what happened after Rona, right? I mean, gosh, we were still getting so much bad news. We still don't know how Rona was going to shake out. But gosh, if you were buying stocks in March of 2020, April of 2020, you made fortunes of money coming out of that. But it was a scary time. Same thing, if you were buying stocks in March of 2009, you got the most attractive pricing in generations of investors, right? But guess what? That market was extremely hated. People still said, look at how many people are losing jobs. Look at how bad the economy is. Look at this. And you guys are out there buying stocks and, the market's racing higher and higher and higher. How are you doing this? The market looks forward. And so the market is looking forward. It's saying things are going to get better and better from here for this next bit of time. And so things continue to get bought up, right? And it's hated. They hate it. Unless you've been buying heavy, you don't hate it.
Managers, many are still cautious because they see tariff risks ahead, and they don't have tariff resolution in hand, and they can't get bullish. I think the feedback we get from a lot of folks is they think stocks shouldn't be rising. So I would say, given the amount of cash on the sidelines, the fact that short interest is going up, and we have a quiet week and markets are rallying, I think the risk is now of a substantial leg up rally from here.
What role do tariffs play in all of the way you're thinking about the market?
Well, that's the thing. What do? You're one of these fund managers. You're 90% plus cash. You're watching the market just go higher and higher. What do? Do you stay cash while the market just continues to rally in your face and the news gets better? Do you start shorting and risk losing all your fund if this market continues to rally higher and higher? Or do you buy and say, you know what? I missed a lot of this upside. You got to understand, a lot of these Wall Streeters have the perspective. It's a horrible perspective to have, by the way. Don't ever have this perspective. But a lot of these Wall Streeters, and I've heard of, I've watched CNBC and hear these Wall Streeters come on, they're in Bloomberg all the time for 16 years now. A lot of these Wall Streeters have the perspective of, I'd rather miss the first few weeks or the first few months of gains, but I was in more downside. Horrible strategy. Absolute trash strategy. The best strategy to have is like the strategy I have, where you see a major correction going on in the market or a major crash, and you're just buying. You understand you can't get everything at the bottom, and that's fine. Because that rally coming out over the next few months, few weeks, it's dramatic. It's not like the market moves up a little bit. No. We just spoke about it. A lot of these stocks are up 30% to 100% plus from where their lows were back in April. So you're a fund manager, you've been waiting. Now you're going to buy a stock at a double X premium. I mean, it's just crazy. But a lot of them think like that. It's a flawed thought process. It's one of the most flawed thought processes I've seen in the market. But a lot of them think like that. And so, you just got to understand, a lot of them won't mind buying. If this market hits all-time highs in the next few weeks here, right, a lot of these fund managers will not mind buying, even though the market's already blasted all-time highs, even if they're way underweight, because they have the perspective, a flawed thought process of, well, at least I saved myself from more potential downside that could have came, and it didn't come, right? So a lot of them have no shame. They'll gladly buy the market at all-time highs if it hits all-time highs in 2 weeks from now. They'll gladly buy, an S&P 500 at 6,400, 6,500, 6,600. They have no shame. They'll gladly buy that. It's crazy, man. Crazy.
Tariffs matter. Remember, before February before Trump sort of talked about this, the base case for many was a 15% tariff. Let's say that we're going to end up at a 10%. That's 10% on 15%, which is imports, which is about a 1% GDP effect. That's not that different than oil going from 40 to 80, and we wouldn't say $80 oil breaks the economy anymore. So I think tariffs aren't, we have to adjust to it, but it's not the thing that takes us to 4,000 S&P anymore.
Now, what if there's a renewed and more protracted, if not dug-in fight over the tax bill? What if Musk's post on social media earlier is enough to get some lawmakers in a very thin margin Washington to rethink their positions based on his political donations or lack of support in the future? Is that a real concern in any way?
Well, this is what's going to be set up as what I'd call event risk. And it's an event risk similar to a government shutdown or an auto plant shutdown, something that affects the economy for a specific period of time. But again, those have not been things to turn structurally bearish. They may be tactical risks, but again, they've always been buy the dip opportunities.
So if for argument's sake, the tax bill ends up not as big as the price tag is on it now, would that be a positive taken by the market? Maybe the bond market would feel pretty good about that, wouldn't it?
Yeah, I mean, Scott, it's kind of hard to say because I could see it being if bonds rally, that's good for equities. But if this tax bill leads to more spending...
I got to be honest with you. These politicians don't care about Musk. They don't care about him at all. You think they're going to magically change because Elon Musk tweeted whatever? No, they don't care about him. They used him for what they had to use him for, which was basically just, somebody that has a very big brand and a lot of people that love Elon Musk, right? To peddle his right-wing propaganda, right? There's left-wing propaganda that people peddle. There's right-wing propaganda that people peddle, right? Now, if you're on that side and you say, it's not propaganda, this is the truth, this is all good, red colt, blue colt, blah, blah, blah. But at the end of the day, they use him what they need to use him. They don't care about what he says. What Elon Musk says is irrelevant to them. And I think he's now learning about power for real. Kind of like the scene in, Dark Knight Rises, when Bane goes to the rich guy, do you feel powerful now? Or something like that, right? It's kind of the situation that's going on here now, where, they don't care about what he tweets or what he says. They're going to do whatever they want to do. And if Elon Musk isn't going to donate money to them, that's fine. There's a trillion other people that are ready to donate happily to them. He's just one guy, one dude out there. Does he have a big pocketbook? Sure. But I can tell you, he doesn't even donate the most money, even close to the most money, out of a lot of these folks. Like there is whole levels to how much some of these corporations, how much these high net worth individuals will donate to left wing and right wing different folks. And some will go directly, some go through these. I don't even want to get into it, but the moral of the story is they don't care what the freak he says.
Even if yields rise, markets are going to focus on the earnings effect. So I'm just going to say it could go either way. I mean, it could be bad or it could be good.
When you hear Jamie Dimon talk about there will be cracks in the bond market, do you just brush that off? Is that, I would expect someone in Jamie's position to be talking about the risks that are in the system? Or do you sit back and say, well, maybe that first little scream from the bond market was before there's a full-on tantrum, which wouldn't be good for equities in any way?
Well, JP Morgan has a dashboard to the U.S. economy because they see consumer credit.
True.
They see it real time. We know consumer credit delinquencies are rising and auto loan delinquencies are rising. But is that going to spill over into the broader credit market to create a credit event? The one market we watch is high yield. High yield spreads have actually managed to hold on to most of the rally gains, and they've retraced 70% of the widening. That's a market that says the economy actually is starting to strengthen.
So you don't put that much cred into bigger worries about the bond market having an issue anytime soon. And even for accuracy's sake, I mean, it's not like he said we're going to have this issue tomorrow. I don't know if it's 6 weeks, 6 months, 6 years. I'm paraphrasing, but that's generally what he said.
Yeah, I mean, I think Jamie's flagging that there are parts of the economy that are weak, including housing. I mean, housing is deteriorating very quickly. But that's also going to deliver a pretty big deflationary pulse. That was 75% of the rise in inflation since 2019 is housing and auto services. So if housing is turning down on price because there's supply, I would argue that's a structural decline in inflation. The Fed would actually have to be quite dovish in the next 12 months. That's bullish.
How many times does the Fed hike between now and the end of the year?
Well, I think you mean cut.
I mean cut. Sorry.
Okay.
I hope that wasn't a Freudian slip. Cut.
Yes.
Again, this is something I definitely agree with Trump on, that the Fed needs to be cutting 100%. Like, there's no reason, zero reason why they should not be cutting. Zero. At the end of the day, the Fed funds rate right now is, where is it? Somewhere around 4.5% roughly, right? CPI is in the 2s. And it's going to be in the 2s. And it's going to remain in the 2s. You have to cut Fed funds rate into the 2s. No debate. You're way too restrictive right now. And I think the Fed's allowing an easy get out of jail free card for Trump if the economy does go south, because he's going to say it's the Fed. They kept rates way too high for way too long. This is their fault. They're the ones that put us into. And he would have a strong argument to be made, because you can't have your Fed funds rate up here when your CPI is way dramatically lower. I mean, we're talking 50% lower than where the Fed funds rate is right now. And there's no inflation worries. You say, oh, tariff, blah, blah. We're seeing no data that's saying like, oh, yeah, for sure, this is causing everything to go up massively in price. Nope, not seeing it, right? And also, you shouldn't be, the Fed's supposed to always be data dependent. If you want to try to predict, what's going to happen to price because this tariff might be blah, blah, blah in 6 months from now or 12 months from now, now you're in an opinion game, not a data game. And the Fed's supposed to be data dependent. The data says lower rates. They should be lowering rates right now. They should lower rates today. Factually. Economics 101, they should be lowering rates today. But they're not. And they, I don't know, like if they have their next meeting and they still lower rates, I think it's a really bad look. It means they're way behind. They're already way behind the curve. It's just a question of how far behind the curve do they want to go. And then we've already seen this game. They already did it once. They already did it back in 2021. They kept rates way too low for way too long, when it was obvious we already have massive inflation problems, but they looked the other way. Now it's obvious we don't have inflation problems and they got rates way too high. Come on, man.
They may not do any cuts between now and the end of the year.
And that'd be fine?
Yeah, I think the stock market, now that we're in June, is starting to look at 2026. And I think the Fed's going to be, they're in a position to do cuts next year. That's what's going to be bullish for equity.
Lastly, still ride this tech run?
Yes, I think the Mag 7 were the first to peak, the first to bottom. They were the washed out stocks that didn't make new lows in April. So we like the Mag 7, but we also like this financials, industrials, and small caps for the second half.
Tom, why do you keep doing this to yourself? Last year, you said you like small caps for the second half. You said they were going to go up 50% in the second half, or something like that, didn't you?
Yeah.
But why do you keep doing this to yourself?
Well, the small caps have gotten hurt because the Fed has been on hold. It's been a hawkish pause, but I don't think the Fed's next move is to start raising rates. So, yeah, I know it's been not a great call, but I think small caps are still a second half story.
All right. We'll leave it there.
Thank you.
We'll keep checking back with Tom Lee.
Yeah, in regards to small caps, here's what I'll say about small caps, okay? They're due. Small caps are significantly lower today than they were like 4 years ago. And I want to say small caps, we're talking about the Russell 2000. They're due. It's just a question of like, it's like being at a roulette wheel. And, I live in Vegas, so, we can always give it to like a gambling term. But so you're at a roulette wheel and you see, in the last 8 spins, 7 times it came up red, 1 time it came up green, right? Now, there's still the same odds as always. That's, would come up black versus red versus green, right? The odds never technically change. But at the end of the day, you look at that and you say, 7 times it came up red out of the last 8, 1 time green. Black is so due. It is so freaking due. It's got to come up, right? And you put $100 out there. Come on, baby, right? That's what we're looking at with small caps. You're looking at these small caps, and it's like they're so freaking due. They're lower than they were, 4+ years ago, and all the inflation that's happened, everything like that. They are due to go on a big run. It's just a prediction of like, are we at it now? Is it still 3 months out, 6 months out, 9 months out, 12 months out, 2 years out, right? All we know is it's due. And it's coming, baby. And so that's what I'll say about small caps. And, you know, if small caps have started a big run, you know, it's very, very bullish for stocks like Cake. It's very, very bullish for stocks like Fubo, stocks like Honest. You know, any of those like smaller cap type stocks, definitely very bullish for even companies like Revolve, RVLV, some of those sorts of stocks I own, right? Because obviously I own big dog companies like Palantir and like Google and Adobe and Amazon, those sorts of companies, right? But I have these small cap stocks that are actually performing very tremendous, even though we still haven't really gone on that beast bull run for small caps. If that happens, whew, a lot of those stocks you'll see skyrocket.
NBC contributors, don't be afraid, Jeff. Just jump into the market, never worry about it, don't look back.
Well, not necessarily, Kelly. If you remember during the depths of the decline in April, I was out here talking about buying with both fists when a lot of people were on here repricing their S&P 500 targets, and you also saw a lot of folks talking about recession. But I think there's a way to thread the needle for all the FOMO folks out there and the fogies. That's a new one, Kelly. I like that. But there's a way to thread the needle, and I think that's using options, defining your risk, because I do believe with the way the Mag 7 has recovered here. Think about the Mag 7. What we saw in the month of May, they were up 13.4%. That was more than double what the S&P 500 was up in the month of May. And to quote my buddy Ryan Dietrich real quickly, when we see a month of May above 5% in gains, that 1 year later, on average, we see the market up 20%. And never have we seen a year of 20% declines. So all the people looking out there for that retest of 4,800 in the S&P 500, it's never happened before, and I don't think it's happening.
Well, so that's the conundrum is you go, okay, well, I guess April was an entry point for a couple of days, and now I get in and we're basically, back up at the highs. And do I just kind of trust it for the, those with a long enough time horizon don't have to worry too much about it. I guess it'd be those if they thought, okay, I'm approaching retirement, or this is for a 529 account, or, do I need something in here so that if there's a wobbly patch in the next 12, 24 months, it doesn't screw up my plans?
Well, it's not going to be a straight path. To your point, we're still figuring out about what the budget, the spending bill is. We just saw that come out from Elon Musk. And we're also still trying to land some trade tariff deals. So I agree with you. Volatility will stay elevated. But I think if you utilize options, and remember, SPY, SPY, that's the ETF that we like to utilize for the S&P 500. Just back in early April, it was trading 481. Right now, it's above 595. So that is neck snapping V-shaped recovery. But I think I want to use an old strategy called a risk reversal, Kelly.
So, here's a problem with options, okay? In this market we're in right now, and I'll tell you about a time period when options might be actually really attractive. Listen, I was looking at, for instance, Tesla options today, put options. And I'm like, oh my gosh, I have to pay so freaking much for these things. It's ridiculous. The premiums you're able to get. So if you're selling options, writing options, there's a lot of premium to be made. And the reason being is we had so much volatility the last few months. So people aren't sure where the market's going, where a lot of these stocks are going. So you can actually get huge premiums, in regards to that. Buying straight up put options right now, man, it is expensive. So expensive. Now, here's best case scenario that could happen. That could be really interesting. Remember we talked about maybe a potential blow off top this summer, new all-time high after new all-time high, right? Let's say that happens. Everybody starts getting really, really bullish on things, right? VIX keeps coming down, and all of a sudden VIX goes to 15, 14, 12. Then the put option premiums you'll have to pay if you're looking to hedge your portfolio very low, because then everybody's going to be thinking about just upside. If anything, they're thinking about calls, right? And I just want to own stocks and feeling great about the market. And if there's not much volatility at that particular time, VIX goes way down, which means put options will be looking very attractive from a buying perspective at that point in time. Put options, probably looking at 6 months out, somewhere around there, roughly. It could go 3 months out, could go 12 months out. So, and that could be a good way to hedge a portfolio. So, you sometimes just got to let time play out here.
Have me selling a put. So I want to sell July 18th expiration. I want to sell that 580 put. It's going to allow me to collect, and I did this trade this morning, so I own it. I got skin in the game. I sold it at $8.65. I used most of that premium, all that premium, to buy the 595 call at the exact same expiration. It cost me $12.60. So it was about $395 I had to lay out per one lot spread for this risk reversal. But you see my break evens at 599. And if we go back up to that all-time high, which is about 6150 in the S&P 500 or $613 in the SPY, I have unlimited upside to this because my break even is 599. So all the FOMO folks and all the fogey folks, I'm using options to define my risk and better understand where I want to potentially come in.
Listen, some of us old fogies just want to just buy it, the stocks, and just hope they go up in the long run.
Exactly, and you don't have to do all this stuff in regards to options. You don't have to worry about anything this man's talking about. You don't have to worry about what even I was saying in regards to hedging your portfolio. That's more of like a more advanced game. I got a whole options course inside the private stock group, and I've got hedging, some great hedging videos in the private stock group on how to hedge a portfolio. But for a lot of people, it's, you don't even have to really learn about that sort of stuff, right? It's more when you're higher net worth, when you got millions of dollars in the market, things like that. It matters much, much more. But, if you got, $10,000 portfolio, $50,000 portfolio, like just worry about buying the dip when you get those opportunities and just doing your consistent either weekly buys, bi-weekly buys, or monthly buys.
We're 3% away from the all-time highs, Jeff, and according to Dietrich, when the S&P gains more than 5% in May, the next 12 months have never been lower and have gained nearly 20% on average. So time to leverage up.
Well, I don't know about that. I don't know about leveraging. I think it's time to continue the momentum, because what do we see in all this momentum? And I was very skeptical, Kelly, of the Mag 7, if you go back to Q1 this year, of being over-concentrated. So I think at the end of the day, momentum moves markets too far. But the S&P 500, it's not overbought on a relative strength index yet. So I think you have more room to run.
Yeah, and based on historical, situations here, at the end of the day, it looks like, things are looking pretty darn good, right? And like I said, these Wall Streeters have no shame, and they'd be glad to be buyers. So in regards to, here's how I would build a beginner stock portfolio with $10,000. Here's what I would go with, okay? I said $1,000 cake. Cake represents a really good dividend value stock with growth along those lines too, and at a very low valuation, right? So I like $1,000 there. $1,000 in SoFi, which represents growth. SoFi, if they keep executing the way they've been executing for the next 10 years, they're going to become a financial giant, right? Which is going to be phenomenal for SoFi stock price. Elf Beauty, one of the best, most well-run companies the past 6 years or so. That's one that just is another growth name there. So I love Elf with $1,000. $1,000 in Meta. Meta's still a steal deal here. Right now, right? Obviously, it was a much more of a steal deal years ago, but it's still a great value. You're paying a forward P of likely low 20s for that, if not around 20, for a company that has double-digit top-line, bottom-line growth. Google McDougal, easy buy here. Obviously, so many worries about AI and blah, blah, blah. I like Google here. $1,000 in Adobe. Adobe was one of the stocks I featured on my main channel video last night. Not sure if you guys got to see the main channel video. It was 4 stocks I'm buying now. June 2025 edition. So Adobe was the very first stock I featured in that video. So if you want to hear me talk in depth about Adobe and why I think it's such a great buy, go to the main channel, Financial Education, type it in, and you can obviously watch that video, and you'll get to hear the other 3 stocks as well, but Adobe was certainly one of them. I said $1,000 in Nike. I think Nike's a really good kind of, beaten down dog stock, but a great brand, obviously, somebody that stays relevant decade after decade, generation after generation, value stock, dividend stock. I like the way they're right-sizing their company. I think that's a good one. Amazon, clearly e-commerce plus AWS plus advertising, $1,000 in Amazon. When I actually switched out, and I'll tell you what stock I switched it out for in just a moment. And then $1,000 in Honest. Honest obviously sells like diapers and baby wipes and like makeup products, like very needs-based business model with financials that are looking really, really good at this point in time. Margin profile, revenue, profitability, everything. And balance sheet as well. So I really like Honest. Now I did switch Win stock out with AMD. I should have put AMD there. Semiconductor company. I think that's kind of a better risk reward profile than Win. I obviously like Win, but I think AMD's even better here. So, and by the way, if you guys don't follow me on X and you want to, I always have that linked in the description area of all my videos, okay? We actually just hit 70,000 followers. I think it was last night or this morning on X. And I also speak about a lot of other subjects that I wouldn't usually speak about, maybe on YouTube, because, we just got a lot to already cover on YouTube. I don't feel like sharing my opinion on this or that, right? So, that's always linked in the description area. And other than that, folks, I think that wraps up about everything we were looking to do there. If you're looking to apply to our private stock group, private wealth group, that will be pinned comment down there today. You can click on that, fill out a form, and we'll see if you're a right fit to join us in there with all the amazing 6-figure, 7-figure folks. We even have the Hall of Fame in here with all the pictures. So once you get your 6-figure club award, you can send in a photo, and then we put you in the Hall of Fame, which is just a very loaded Hall of Fame. And then we have our 7-figure Hall of Fame of all the different members that have hit 7 figures over time, which is just phenomenal to see, obviously. So, alrighty guys, much love as always. Appreciate you joining me, and have a great day.